Good morning, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing Podcast. As always, I am your host, Real Estate Cody, and with me again today, the coffee connoisseur, Mr. Brian Alfaro. Brian, how are you feeling this morning, buddy?
I'm doing okay, Cody. It's another Thursday morning on a short week after Labor Day, so it's nice to have the weekend in sight.
It sure is, and it actually feels pretty good right now here in Houston, right? I mean, it's no humidity, still hot, but
Enjoy while you
much
can.
enjoying what I can. That's exactly right. Well, Brian, listen, it's been a fun week. I've been spending some time talking with all of our broker connections, and all indications point towards a very busy and active Q4. There's still a ton of deal flow coming to the market as of late. So, for any buyer that thinks that things are going to be slowing down here in this Q4, get ready. I think there's still plenty more in the pipeline, which is good news for us. So,
That's right. You got to stay ready.
that's it. That's it. So, well, I'm excited about our very special guest today, man. Who are we talking with?
All right. Today we have Brian Kasal, and he is the CEO and founder of Four Star Wealth Advisors, an SEC registered investment firm headquartered in Chicago. Brian holds an MBA from the University of Chicago's Booth School of Business and has been a guest lecturer for their MBA program. Four Star Wealth Advisors is a registered investment firm advisor headquartered in Chicago, as mentioned. They're an independent firm without the conflicts or restrictions of the old school firms. Money and wealth are tools to help investors get where they are going and achieve their hopes and dreams. They would like the opportunity to help their clients realize their hopes and dreams and achieve their financial goals. Brian has been a member of the Portfolio Management Institute, PMI, as well as a senior portfolio management director and senior vice president of Morgan Stanley. Brian has also served clients at Payne Weber, Lehman Brothers, and for 15 years at William Blair and Company as a senior principal in the private client portfolio management group. Sounds like you have a wealth of experience. Brian, welcome to the show.
Thank you. Good to see you, Brian, and Cody. Really?
Yeah.
Yeah.
Thank you. Yeah, likewise, man. Excited to have you here. And Brian, as you alluded to, a very extensive background, some very reputable, companies that you've been a part of. So tell us a little bit more about your diverse background.
Sure. So started out as a stockbroker in the 80s. That's what they called it back then. Then everyone morphed into becoming an investment executive or a financial advisor, right? So back in the old days, you were just selling product to people, but the world has changed a lot where most investment people are now fiduciaries, at least on the investment advisor side. And that's the right way to be, where folks are obligated to their clients' best interest. And that's the investment advisor side. So after 30 years of being a senior producer, senior partner, money manager, leading a team and all that, I decided it was our turn to run this and founded Four Star Wealth in 2014. Plus, there's so much more flexibility and things that you can do in an independent firm that you really can't do. As you start an independent company, you realize that a lot of the rules had really nothing to do with the SEC or regulators, had to do more with your firm. So now you own the firm and you can make better choices for your clients and give advisors the opportunity to do a lot of great things for their clients, which is really the fun part.
Absolutely. Yeah, I got to imagine that's pretty rewarding feeling to break those chains, so to speak, and be able to service your clients in a way that maybe you were limited to doing before.
Yeah, things are moving very fast. Like even cryptocurrencies and Bitcoin, everyone talks about that constantly. Although ironically, not a lot of investors are actually in it, but everyone talks about it.
Not yet. Not yet.
Yeah, they will be eventually, right? They will be, but most brokerage firms don't even allow people to do those kinds of things, and then many of the private investments like real estate, like what you guys are offering, in many ways, it's very restricted as what you can do at a big brokerage firm. But in the independent space, we have a lot more freedom, and we do a lot of alternatives in that sense as well, because we have that freedom, and we have one of the largest alternative platforms out there. So it's an exciting time to offer things to clients that they really can't get in most places, which is a lot of fun.
Cody, I love what they're doing. It's very similar to some other people we've ran into where, a lot of people are used to these larger national brands, which have maybe helped them sort of build their wealth. But I think diversification is the name of the game. And there's so many different asset classes where you can not only make a good return on your capital, but also, spread your risk out a little bit. So I think firms like Four Star Wealth and what you guys are doing is phenomenal, adding value to clients and giving them different options. Because I think there's definitely a need for that out there.
Sure. And as you meet wealthy investors, we talk about the high net worth and ultra high net worth investor. they're doing most of these other things anyway. They're just not doing it with their, their wirehouse advisor,
Sure.
UBS, Morgan, right? So we want to be part of that equation and part of every piece of the equation for an investor. And part of it for me was at University of Chicago when I was at the MBA program. A group within our class founded the Hyde Park Angels, which is now still University of Chicago sponsored, but the largest angel network in the Midwest, and I'm not sure if they have the #1 rank now, but they've been #1 ranked in America for about 5 years. And that was all angel investing. It's basically I like to say it's Shark Tank without the music and drama and crying, which they have on TV, right? No crying. Maybe not in the room, maybe on the side, but so when you do early stage investing, again, you can't really do that at big brokerage firms. So you learn that there's so many more things out there, and why can't we let clients participate in that if it's appropriate for them, and they're the right kind of, it's suitable, appropriate, and the right kind of investor? Why can't they be part of that? But a lot of the firms won't allow them to do those things, given the right client. So it's pretty fun.
Sure. Well, as you mentioned earlier, you referred to the term of being fiduciaries, right? And I think as a fiduciary to other investors' interests, you have that responsibility to provide the type of verticals that fit their investing thesis, right? And not everybody fits into one box. Although I think that's the way we've been conditioned, right? Is growing up, the idea of financial wealth was always tied to mutual funds, 401k investing, and then equities markets. But as you already alluded to, man, there's so many other verticals that could help you really preserve and grow your wealth over time that you have access to. You just need to have people like yourself that can help show you the way, so to speak.
Absolutely. Most investors consider alternatives to be real estate, and real estate obviously is a major part of it. It's what we live in real estate, whether it be a home or a condo unit or whatever. We also invest in it. There's a lot of cash flow. There's a lot of leverage to real estate. So it's always a great investment given the right investor. But there's so many more areas of alternative investing that are available now, whether it be cannabis, or we talked cryptocurrencies, wireless infrastructure. We've got farmland deals. I mean, literally dozens and dozens of categories of private investing that you can't really get in the public markets. It's different. And most investors have no access to that unless they work with an independent firm. So we want to be part of all of that. And we mentioned earlier too, in the pre-discussion about, things you can do as an investment advisor that the brokers really can't. We do rotation models where we'll get folks out of the market. And for years, everyone says, well, don't try to time the market. And, we're not really trying to time the market, but we certainly are trying to find trends. So if there's a big downturn happening, those are pretty well signaled by the market if you kind of track the mathematics of all of it. So you can get out of the market partially or completely, depending on how you follow a process, and then get back in when things are better. If the market goes down 50%, why would you want to hold your stocks all the way down there? Maybe you can sell some of them or all of them and sit out for a little bit. It's possible to do that, and we found a way, I think, to do that.
That's a great point. And we talk about this a lot in our industry, right? Where we look at historical trends to help us make the best educated decisions we can moving forward. And I was listening to a speaker the other day, and I forget who it was, but we were talking about the current state of today's market, right? We have obviously this post-pandemic recovery. You have a lot of speculation about inflation, if it's going to be runoff or if it's just going to be transitory, and leads into a bunch of different conversations. And you look at the amount of quantitative easing we've seen so rapidly injected throughout this recovery. Point is a lot of people are speculating on what the future will forecast, but the speaker's point that I was listening to was saying, look, if you look at the historical trends and where we're at now, our behaviors have not changed, right? The trends have not changed. And so where we are today, even though it feels out of place, it's actually not very much different from previous economic downturns or cycles and things like that. So I think it's important to put that in perspective and like you said, pay attention to those historical trends. What would you say?
Yeah, absolutely. We are in somewhat uncharted territory, at least as far as what the markets will react to. with the Fed agreeing to liquefy the banks to the tune of $6 to $8 trillion, and then between the end of the Trump administration and the beginning of the Biden administration, I think we've added another $6 trillion to the economy of spending. Some of it paid for, some of it not paid for, but nonetheless, it's coming out there, has and over the next few years. So we've never really put 10 to 12 to $15 trillion into our economy in 2 years. So we don't know what that's going to do. It appears to be causing inflation. It appears to be money chasing goods, and then we had a restriction in production. So certain goods exploded in price. We had inflation that's developed last year. Then stock market's probably moving up partially because of that, because there's a lot of money out there chasing stocks, chasing other investments. Real estate's gone up. Try to buy a new car lately. I mean, car prices are moving up. So there's so many aspects of a lot of money out there causing things to move in this economy. So it's been quite a strange time.
It's all in real estate.
It's real.
It feels that way, Brian.
Yeah. And the new home price hit record, or home prices hit record highs in America as well. So everything is up. That's no one figured that when we went into a pandemic like that that's how it would play out, but that's exactly how it played out.
Sure. Yeah, I think you're absolutely right. I mean, 2 years ago, we were all sitting around the table thinking like, man, are we getting near the peak here? Is it, where's the cliff? And then
Right.
COVID hit, that came out of nowhere. But then after COVID, I mean, things have just skyrocketed from there. And as you mentioned, and so it's been an interesting market cycle, to say the least, or interesting recovery, to say the least. So, but I think it's important to bring us back to the point of working with independent financial advisors like yourself, and having guys like you and your team to kind of help guide through some of these, like you mentioned, uncharted waters, right? And to kind of keep the finger on the pulse. And as much as we like data and we want to sit there and try to study and keep our finger on the pulse, to me, there's information overload right now. There's so much data and statistics and information that's coming at you from every different forum. And so it's hard to keep up with, and it's hard to really disseminate what's actual factual data versus what's speculation. So I think it's great to have guys like you, working with you to help with that.
Yeah, well, and you bring up a really good point. There is way too much data out there, and it's all easily available. And so people are in data overload, and there's analysts telling them to do this, and strategists on every show telling them to do that. And the key is to find out what information is really important and just follow those bits of information. There's only so much the human brain can absorb, and frankly, a lot of it is garbage. So figure out what matters and what doesn't matter, and that's how we led to trend following. We follow fundamentals, obviously, of good companies, and some companies are in a rough go because of the pandemic. Some are doing better, but at the end of the day, the market decides what we're going to invest in. The market decides what's important. So we'll follow trends, and we need to beat markets. And so that's why we developed the trend following system. How to find a way to beat markets in a market that may be confusing. Actually, it's not. It's all in front of you. All you have to do is figure out how to read it and know what's important and know what's not important, and get out of the bad stuff and stay in all the good stuff. That's basically how we do it.
You made a point there, Brian, and Brian Alfaro. I'm gonna have to figure out how we go back and forth here. But Brian, you remember the conversation we had with Mark Hamilton several months ago, and Mr. Kasal, Brian, we had a former gentleman on our podcast, big real estate private equity firm, $4 billion in assets under their management. But he made a specific comment that just still resonates with me today. He says, you got to let the real estate tell you the truth. The real estate will tell you the story. You just got to listen to it. And it's exactly what you just mentioned. You got to look at what's in front of you and let the markets tell you the truth, and I think that'll help you make better financial decisions.
Well, I think the reality is too, and Brian, you'd probably agree to this, and why it's important to have firms like yourself is, whether we realize it or not, we're talking about data, but there's a lot of emotions involved with this. And a lot of the stories and stuff that you read, if you're watching the news or you're reading stories on big, websites or whatever, it's probably too late. And they're also pulling at your emotions. So if you read too much or you get analysis paralysis, you start getting emotional about your decisions, because you get what we call in the crypto world, like FOMO, fear of missing out. And you start investing in things that maybe are actually on the downturn or at the peak, and having advisors like yourself that are constant, that have paid professionals that are keeping their finger on the pulse and that are letting you know, like, hey, you're making an emotional decision. Let's make an actual, like a strategic decision that's not so much based on emotions. I think that's the real power of employing firms like yourself.
Yeah, thank you. There's an old adage that traders use on the floor of the exchanges in Chicago: don't fight the tape. And all that means basically, if you see the market trend going in a certain direction, let it go and react to it, but don't try to take the other side of the trade. It's a good way to die. If the market's going down, maybe you stop buying for a little while, and see what happens. Let it bottom out. Let it figure out. Same thing. If the market's moving up and you're selling into that market, well, maybe it's going to go a lot higher. Maybe you should hang on and don't fight it. Let the market do what it's going to do. I always like to say the market tells stories. We just have to be able to figure out how to read it better.
I like that.
Yeah, I do as well. I think that's a great point. And I mean, look, the reality is there's very little that we can do to influence, I think, some of these things that we're seeing in the marketplaces, right? I mean, we're just all one individual investor. There's not much that we can do. So to your point is you can't fight it. You got to be able to go with it, pivot, and just make rational decisions based on your experience and the knowledge that you have, and learning how to read the story, so to speak.
Well, guys, there's also this notion that the small guy can't make it in America. The markets are too big. The big money moves the markets. And you hear all those kind of like fantastical stories about, how we can't do any good in the markets anymore. It's actually quite the opposite. A smaller investor can get in and out really quick. As our firm grows and we get larger and larger, we're moving larger blocks of stock. It gets harder to move those blocks of stock. So smaller investors can get in and out quicker and follows trends and move faster, more nimble than big investors. So the small investor in many ways has an advantage over the large investor. And if they just play that advantage the right way.
Sure. We see some of that in the real estate space, especially looking at commercial real estate. Us as private equity firms, we have a lot more flexibility in the type of assets that we chase or acquire, or the type of strategies we can employ with our retail investors. Because if you're looking at the institutional buyers, there's a very strict buying criteria, very strict return profile, and it's that box or nothing, right? There's no other flexibility. So I think to your point, yeah, it's a good reminder that, the little guy can make it, so to speak.
A really good example of this is the commodity markets. If you follow trends, we had a really hot commodity cycle. I'm going back in history a little bit to 2010, where most commodity prices are moving up. We had a little commodity rally in 2015. And other than that, it's been pretty rough until the pandemic. And all of a sudden, all the commodities are moving again, right? So we've got lumber and the industrial metals are moving because they're in demand. We're having agricultural commodities move, precious metals to a lesser extent because of Bitcoin. I think the Bitcoin and whole crypto world is kind of taking a little bit of the excitement out of the precious metal side. But we haven't had a commodity market for a long time. But now, if you see those trends and you can hop onto them, you can do very, very well. And you don't need to be a big institution.
Absolutely. Well, that was going to lead me into one question I wanted to make sure to get across. And we've kind of been alluding to this already, Brian, but why should an investor be working with a registered independent financial advisor like yourself, aside from the obvious, like we just discussed, access to other vehicles, access to experience like yourself that can help navigate all of these data and trends that we're seeing? But what's the added benefit of working with people like you guys at 4Star?
Well, I think the key in working with the investment advisor space, excuse me, in general, and then is that you're working with a fiduciary advisor. So that advisor is obligated to your best interest. At some firms, they still have a broker standard, and that means they can sell products to you. And you're never really sure whether that investment the advisor is bringing to you is something they're making a commission on or they're not. We have no axe to grind in the investment advisor space. We get paid the same amount no matter what the investor does. So our objective is to do the best we can for them. So that's really an important factor, that folks need to work with an investor who is obligated to their best interest. Now, most investment advisors are that way, and most brokers are that way too, because most Americans are good people. Most investment people in the industry, no matter what their standard, they're good people and they're trying to do the right thing. But there are some that aren't. And so when you're in the investment advisor space, besides the fact that it's the right thing to do, I'm a Boy Scout as well, and we try to do the honest thing for investors, right? but we're also legally obligated to that objective. And that's a good thing to have all those things aligned together. So that's a big thing. Then the other aspect of working with a firm like 4-Star specifically is that we do have one of the broadest platforms in the industry. And there's so many more choices that you have here that you don't have at other firms. You may not know this, but many of the brokerage firms restrict what their investment people can show you. So even if it's right for you, if it isn't right for the firm may say, no, you can't show that to your investor, where we don't really have that restriction. Our restriction is what's right for the investor. Is it suitable? Is it a good investment? Is it the right thing to do? And that's really the filter that we use, not what's approved by my firm. And gee, does the firm make extra money on this or not? None of those issues come into our equation, but they do come in elsewhere. And people don't totally know that. They're not aware of that when they're dealing with an advisor. So ask your advisor lots of questions. Is there a commission paid on this investment? Who gets paid? How much do you get paid, right? It's all should be disclosable. And we disclose everything to our investors on the agreements they signed with us. And we don't want them to have anything hidden. There's nothing hidden. And anything that there's a whiff of a conflict, it has to be disclosed in our ADV document. And so all that is disclosed.
Yeah. You know, I appreciate the two biggest things you mentioned there. Number one, the transparency, which I think is as an investor is so important to us, right? And, you know, whether it be good or bad, that having that transparency is so important because, you know, I'm relying on you as my financial wealth advisor to tell me, you know, or help guide me right into what some of these strategies are, or what I need to know in certain verticals. And if you're not disclosing that to me, it could leave my investment or my interest at risk. I would argue, right? But number two, I do respect the fact too that you're putting the financial responsibility or the decision-making responsibility into the investor's hands and letting them dictate, you know, their own investing strategy. And you're just kind of being there, like you said, in that advisory role to help them make those decisions. And I really respect that as well, because you're right. That's not something that you see, I think, throughout the entire industry, and we need more of it. You know?
Yeah. When we spend a lot of time talking to an investor about their tolerance, we use risk and the analytics software to see, you know, what kind of things make an investor nervous. What are they comfortable with? We call it the sleep at night factor. If you have a portfolio and you're waking up in the middle of the night worrying about it, you have the wrong portfolio. You need to change it. You should be able to sleep at night with your portfolio. And some investors have very high risk tolerance and they're comfortable with that. And some can't handle it at all. You know, the classic is the 60-40 portfolio, 60% stocks, 40%, I call it risky bucket, safe bucket, right? That's the standard model. But there's so many ways to tweak around those edges. Some people don't want to hold money in 2% bonds anymore or 1% bonds. They want to do different things. Well, that's fine, but that increases your risk. So you have to understand all those things before you go ahead and do it. And our objective is to give the investor what they want and make sure they understand the risks of what they're doing.
Yeah, that's very important. Let's talk a little bit about that. Let's use that as a piggyback. What does the client relationship look like between advisor and investor? You know, as far as the type of communication, you know, your team offers. You know, is it an open dialogue at any time we have questions, or is it, hey, you know, you can only schedule a call with us once a quarter? I don't know. What's that client relationship look like between you as the advisor team?
Well, most investment advisors, you know, run their own shows. So they design their own model. But, you know, there's generally been a view that you kind of review it every quarter. I think that might even be a little bit too much, at least every 6 months. And most certainly yearly, look at your portfolio, what's going on. If you set a plan in place, you don't need to look at it every day. You know, the guy that looks at his portfolio every day and is kind of obsessing over what's going on in his phone every minute could drive themselves crazy, right? And you really don't need to do that. If you really have a plan that's long-term, why are you looking at your phone every second day worrying about what this stock is doing or that stock is doing? So you got to keep in perspective what's important. If you have a review every 6 months, once you've made a plan, that's probably more than enough to make sure that your plan is in place. When you go through a financial plan, most advisors do a financial plan. Then you'll put in, we're going to save a certain amount of money in IRAs every year. Maybe we're going to do a 401k. We're going to buy a car every 5 years. And you build all those things into it. When you retire, Social Security, any other pensions come in, and you manage the cash flow stream and figure out how to achieve your goals. Then all you have to do is follow to make sure you're on track. And if you're off track a little bit, then you can make course adjustments. It's not the end of the world either. But most advisors do something like that, where they make a plan and then at least every 6 months or at least yearly at minimum, do some sort of review to make sure you're on track.
Awesome.
I think that's a pretty good expectation from a financial advisor team.
Good. I like that. Yeah, it's important. Like you said, you want to be mindful of the growth of your portfolio. You want to be mindful of the trends that are affecting your portfolio. But I think, Brian, you talked about this earlier, right? You want to be able to remove that emotional factor out of it, because you're absolutely right. If you've got to look at your phone every day and you can't sleep at night, it's probably not the right vertical for you.
There's a line in an Eagles song years ago about how you let the sound of your own wheels drive you crazy. And that's what a lot of people do. They obsess over things that aren't important.
Sure. Yeah, there's a peace of mind as an investor when you can just sit back and trust that the long-term plan within your portfolio is going to be there. And, there are certain hedges that, you could implement in your strategies that'll help protect your downside, which I'm hoping we're going to get to here in a minute. But this is good. Brian, what do you think, man? I love talking to guys like Brian.
Absolutely. Yeah. I mean, this is such a wealth of knowledge, because the average person doesn't have this knowledge or the skill set to go out there and make these smart financial decisions. And having that trusted advisor in your corner can literally be life-changing. So, Brian, I have a question. For you, when does Four Star like to get involved? What type of investors are you working with? Are you working with just W-2 employees that are looking to build their wealth? Or are you looking to work with ultra high net worth, or just kind of a mixture of both? And when is it somebody's, if we have a listener who's listening to all this and they're like, man, this sounds awesome, I'd love to reach out to Four Star. When's the right time to get somebody like you involved? Is it as a young professional when you're in your early mid-20s starting to set yourself up for success? Is it or is there another place in their lifeline that makes sense for you to get involved? Talk a little bit about that so our listeners can have a little bit better of a picture.
Sure. Well, I think the best time to do a financial plan is actually right when you finish college, right? So everyone's like, well, that's crazy. You're nowhere near retirement. But, the money you have early on in your 20s and 30s, if you do the compounding and do the math,
Yep.
It's so powerful money you'll ever invest, because it's in there for 30 or 40 years, right? But usually what happens is people wake up in their 30s or 40s, maybe they get married and have a child, and they realize, oh my God, I better plan, and if they do a little bit of planning in their 20s, they can do incredible things that affect them in their 40s and 50s. So it's never too early to do a financial plan. And we try to encourage all the families we work with to do it right away. The reality is not everybody does it right away. So we try to encourage them as soon as they can. And then it's just as simple as, I'm going to pay off my college debt, and I'm going to work on, building a financial life, open an IRA. Oh, my company's got a 401k. I better do all I can there and fill up what I can in the 401k. That's the way you build a financial life. Get out of debt, start building assets, and do it consistently and follow a plan. So, we really love to do financial plans for people in their 20s. And they sometimes look at us like, this is a little crazy, isn't it? No, it's not. This is the most powerful money you'll ever have right here at age 25. So put money into an IRA and let it grow for 50 years. It's pretty powerful.
Sure.
Pretty powerful.
Yeah, and we've alluded to this several times before on prior episodes, but this is the failure of our education system in not providing this financial literacy from the time that we're in youth, right? I mean, we go through all these didactic courses as we go through grade school, and yeah, we have a good fundamental education, I guess, but reality is most young professionals, when they're getting out of high school, when they're getting out of college, they have no idea on what financial literacy even means, number one, much less where to even start. So I think that's an unfortunate failure of our system, but it's great to hear that, you guys are trying to get engaged that early on. And I always get inspired. We've had a few guests on our show that are starting 18, 20, 22 years old on their financial journeys. And I think that's so inspiring because, it's the more sophisticated our youth can become, I think the more successful, entrepreneurs, investors, whatever the case may be, we have in the long term. I think that's good. And that's where we look at when we talk about generational wealth. I consider that financial literacy as part of generational wealth. When you can pass that down to your children and teach them from a young age, so that way they can avoid some of the common I don't know, pitfalls, I guess is how I would describe it, as most of us in the community have grown up to be conditioned to believe that's financial wealth, you know?
Absolutely. And if you want to work with an advisor, that's a good thing. And Four Star has advisors at all levels. We have some advisors that have lower minimums. And when we talk about account minimums, it's only you want to make sure you have an advisor that has you have his attention, right? Most financial advisors individually can handle maybe 100 families and no more than that, unless they have a bigger team, then they can handle more. So as advisors grow, they may have to raise minimums because they can't work with that many people. They just can't physically do it. So, but there's different practices within our firm. We have some advisors working with corporate executives and ultra high net worth investors, and some work with more of a mass affluent people who are developing and growing. So if you want to approach us, we'll find a financial advisor to work in your segment. If you'd rather do it yourself, there are so many tools. We talked about that information overload. There's also systems overload, Mint, Quicken, all these different systems. They have basic financial planning software. And maybe it's not as sophisticated as some of the things that we might bring to the table, but a lot of it's still pretty good stuff. And you can find some pretty good financial planning software out there for free at Fidelity and Vanguard and some of the firms. So there's plenty of information out there. If you really want to plan, you can do this on your own, or you can work with an advisor, and even work with an advisor until you're ready to do it on your own. You don't have to be with an advisor forever. If you become really good at it, then you can do it on your own. Some of our investors, when they retire, they do run their own portfolio because they have more time. And some still just want to say, do it for me. I want to hang with my grandkids. Either way, right? So.
Absolutely. Well, Brian, I want to make a pivot here. And because we were alluding to the show, I think you guys as those financial advisors, you're looking at ways to protect an investor from the downside risk, as well as also capturing the wins on the upside. And I know, like, when we look at investment real estate, that's exactly what we look at, right? We look at, hey, what's the potential upside that I can maximize, but also what's my hedge against the downside risk when we get these investments? That's what helps us make the best decisions we can. And that's transferable across all vehicles, I would imagine. So I want to get into that a little bit and have you talk to us. How are you guys doing, protecting your investors to that degree?
Sure. We call it our 4-Star protection program. Basically, within 4-Star Wealth Advisors, we're an advisor, but we're also an investment manager. Not every investor has their money managed by 4-Star at 4-Star, but about half the money in the firm we still manage for for certain clients that want us to. And within that portfolio program, we have 16 models we run. 4 of those models are growth models, wealth accumulation models. One is a dividend stock portfolio. Another one is a growth stock portfolio. Another one is a dynamic rotation multi-asset class model. And those will, in the moderate version, get up to 50% cash in a rough market. And 2 of the models will go up to 100% cash in a rough market. So how do we do that? Well, 85% of the time, the market's going up, right, in a normal fashion, kind of sleepy, go up, go down a little bit, but a general uptrend. That's a normal market. But about 15% of the time, we're in market correction mode or all out panic crash, right? So it's those times you want to protect the downside. And everybody's a hero when the market goes up. But when the market goes down, we do crazy things. We panic and we always sell at the bottom, right? And then once you sold at the bottom, you don't know when to get back in. So you have to have a plan. You can't just wing this. You have to have a plan in advance. So through a series of maneuvers that we've made over the years, we developed a system that will identify when the markets are high probability of moving down. And usually around 10% down from the high, we'll start to take some kind of protection. If the market is down 20%, it's in bear market territory. What we want to do is avoid the 30, 40, and 50%, 60% declines. The worst market in modern history was in the 1970s when the market went down about 75% from the high. We don't want to ride it all the way down. So somewhere around 10%, we'll get our first signal to get out. Then there's a series of other indicators that will get all the maximum cash levels out by about down 15 to 20%. The first 10% or 15% down from the high, pretty hard to protect against that. What will kill your portfolio in the long run is if you're down 30, 40, 50%. It'll take you an entire decade to make If you're down 50%, you have to double your money to make it back. That'll take you a whole decade. That's what we're trying to avoid. So in the pandemic in February, started February 19th was the high. I don't remember exact day of the low, but it was, I believe, in late April. We were maximum cash levels. Two of the portfolios went to 50% cash and two went to 100% cash. We were maximum cash within about 3.5 weeks. And then the market kept going down for another month and a half. And then it bottomed. You don't know when the bottom is going to happen, but it happened. Then it started slowly going up. We'll get signals to get back in. Again, they're based on probability. They're not foolproof, but they're based on probability. It works pretty well. And we slowly got back in. We got fully invested again by mid-June, right? So a real roller coaster. That was the fastest 35% decline in American history. And we had to do some pretty fancy footwork to get out, and then pretty fancy dancing to get back in. But the indicators work pretty well. And in my 27-year career as an investment advisor, we've only done that maneuver 5 times. Doesn't happen all the time. Anybody remembers the tech crash of 2000, 2001? Then the big, what they call it, well, the economic collapse of 2008, 2009. There was a big downturn in 2015, 2020. These are the times that we made these moves. And we hope it doesn't happen again for a long time. But when it does, we're ready. We have a system to do that. So you can design that system on your own if you want to, but we already have it in place. So it worked really well. 2020 was one of the worst years in a long time as of the end of April. But the S&P ended up 18% for the year. The NASDAQ was up over 30% for the year in 2020. So if you fell asleep at the beginning of the year and you didn't see all that movement, you'd say, oh, it was a great year, right? But it was a very volatile year and a lot of people got hurt, right?
Sure.
So our job is to make sure that we don't catch the big part of that downside and that we ride the normal movements upward. So last year ended up being a fabulous year for our investors relatively, because we gained 20 points on the downside. Our worst account was down about 17% when the markets were down 35 and 40. And that was all equity accounts. We managed to keep about 10% of that advantage on the way back up, 10 to 15 in some cases. So we had investors with those growth portfolios up 28, 30, 35% in their stock portion. That was pretty good. That wasn't because we were smarter on the upside, because we just lose as much money in those 2 months when everyone else 40%. So that's how we did. So it ended up being a great year, but it was a bad year for the world, but ended up being a great year for the stock market.
Sure. Well, and you bring up another great point. I think this goes for any type of investor, whether it be equities, commodities, real estate. I mean, look, if you are transacting in any one of these vehicles, you're going to experience a downturn. You're going to have a circumstance where, you're going to lose to some degree. I mean, like you said, unfortunately, I was hoping you were going to tell me you have your crystal ball and you guys can, call it any time. But the reality is none of us do, right? A lot of this is still a lot of speculation to some degree, but you're absolutely right. I mean, look, when we talk about hedging against that downside risk, we're all going to find ourselves in a circumstance, if you haven't already, where you're going to experience that. But how can you mitigate the maximum effect of that, right? How can you prevent you from losing that 30, 40, 50%? Because you're right. We talk about this all the time as well. For us is, when we look at income statements, it's not always just going out and pushing rent and pushing overall, other income that we're looking on our property. It's also about expense management, right? How can you reduce some of the expenses and whatnot? And, if you do experience a correction and you do start having your cash flow being affected by that, can you still keep the lights on? Can you still weather the storm long term enough just to ride that through? And like you said, things will naturally, eventually, hopefully pick themselves back up. So, all great points. And again, I'm really glad we're having this conversation, because I think what you guys are speaking to and providing for your clients is something that could be transferable across multiple different strategies. So.
Absolutely. Yeah. And then in the real estate analysis there, the idea is basically you're not sure you have the cash, don't spend it. Right. Mm-hmm. So you have to restrict your expenses and everything. And if we're in our world, If we're not sure that it's time to take risk, we don't. If the markets are going up, then we'll take risk. But if things are really volatile and really messy, we'd rather sit on the sideline for a little bit. That's the whole idea behind the protection plan.
Yeah. Yeah. I really like that. And I think that's a great way. And I think that's an approach that every investor should be looking at, is looking at those various strategies. Cause you're absolutely right. You have to be able to make those pivots when the market's telling you the story, when it's kind of indicating to you like, hey, this may be something to pay attention to. And I think that's the difference between those who we've seen successful. Listen, you can be a successful investor in any market cycle, I firmly believe, if you have the knowledge and wisdom that, you were just describing, and have that capability to hedge against some of that downside.
Well, and we as investors, whether it be real estate or the stock market or the bond market, we have to create mechanisms and structures to protect ourselves from our own emotions. And investment advisors are just as emotional as any of their clients. In fact, probably more emotional, right? So we have to create some sort of structure. Here's a risk level we're comfortable with. Here's a risk level we're not, and know what those are and make decisions based on that, and make sure that we don't do foolish things or panic at the bottom, or put every dollar in at the top, and all those things that we're bound to do if we don't have a plan. If we don't plan, we will fail. So you have to have a plan in advance. You have to think about this before it's time. When you're deciding at the bottom, gee, should I sell? That's the wrong time to be thinking about it, but you don't know it at the time. But that's how bad decisions are made. So you have to really think about this stuff in advance and have a plan.
I like that. Have a plan in advance. That's a good one. That's going to be a good nugget there. So, well, Brian, do you have any other questions for Brian?
No, this has been phenomenal. I think this is such a wealth of knowledge, and something that, our audience is very interested in real estate. That's what we talk about all the time, but being diversified in different sorts of asset classes, and also thinking about wealth preservation as well, is super important, because the old adage is it's not how much money you make, it's how much you keep. Right. So having great firms like Four Star Wealth involved in your portfolio as you're building it, and then also figuring out like, hey, I just made a bunch of money selling a property. What should I do with this money to make sure that not only I keep a lot of it, but I don't necessarily have the tax burden? I think that's super important for all of our listeners to consider. And I definitely encourage them to reach out to you. So this has been great.
Yeah. Thank you, guys. Thanks for having me. Appreciate it.
Yeah, absolutely, man. Really appreciate the wisdom shared here, and again, respect what you guys are doing, and really hope that this resonates well with our audience, because I think we need more, independent financial advisors like you guys out there, really promoting, just a transparent vehicle for people to really benefit from an advisory team, and helping them grow their wealth really on their own terms. I mean, and I think that's key. When I can take control of that financial independence, but rely on people with your expertise to allow me to do that, I think that's where, real wealth preservation really can succeed. So, but Brian, tell the listeners how they can learn more about you and Four Star and get connected with you.
Sure. You can just go on our site, fourstarwealth.com, call our office, 312-667-1750. You can ask for me, or talk to who answers the phone, and connect with me, and then I'll connect you with an investor, advocate, advisor that will help you get where you need to be.
Awesome. Well, Brian, we really appreciate your time again. Thank you so much for tuning in with us today.
Thank you, guys. Thanks very much for having me.
The next one.